Welcome back to the Value Investors Club. I'm your host, Simon Wunderlich. Let's get right into it with the VIC readings, the format where we look at the best of the best value investment recommendations by the best of the best value investors out there. Thank you very much for tuning in. This is not recommendation, not advice, only for entertainment. Please do your own diligence before investing into anything. Today we have UNIVAR Solutions Inc., UNVR. Price at the point of filing was $25.68. Description: Company background. UNIVAR Solutions, UNVR, is a leading US-backed full-line chemical distributor. The company purchases chemicals from thousands of chemical producers and then warehouses, repackages, blends, dilutes, sells, and transports the chemicals to 100,000 plus customers. Chemical distributors' value add to chemical suppliers is providing an inventory that allows for just in time delivery and easy product availability for the customers. Additionally, Univar blends and packages products as necessary for chemical customers, ensures a safe and secure delivery that is regulatory compliant, and acts as a sales agent for more specialty chemicals. Value add provided to chemical customers is that Univar provides a one-stop shop for thousands of SKUs and an information source for more obscure specialty products. The company was founded in 1924 but didn't become the largest chemical distributor in North America until acquiring McKesson Chemical Corp in 1986. The US share was further solidified with its purchase of Chemical Central in 2007, Basic Chemical Solutions in 2010, and Nexio Solutions in 2019. Univar originally IPO'd in 2002 and then was acquired by CVC Capital for $2 billion in 2007 and then CD&R for $4.2 billion in 2010. CD&R began its exit by IPOing the company in summer 2015. Univar is the number one player in North America and second player globally. Total global chemical demand pre-pandemic is $4.5 trillion, of which 70% is distribution relevant demand. Out of these distributed chemicals, only 11% are distributed by third-party distributors like Univar, given chemical suppliers largely transport bulk shipments themselves directly to large customers. For chemical producers, 80% of their sales are typically concentrated in the top 20% of the customer base, so they tend to transport product to the larger customers themselves that require large volumes. Univar and other distributors specialize in warehousing and transporting chemicals that are not purchased in bulk, but rather by customers that spend only less than $125 or less per annum. Both the North American and global markets for chemical distribution are relatively fragmented. Univar's number one share in NA equates to 13% market share versus Brenntag at 10% and IMCD at 2%. And Univar's number two share globally equates to 3% market share versus Brenntag at 5% and IMCD at 1%. Thesis: For Univar, the decade prior to COVID had been challenging, and it showed through a lack of consistent EBITDA growth. High management turnover and chronic underinvestment, while PE owned, drove most of Univar's historical issues, such as an inefficiently incentivized sales staff, antiquated IT systems, poor on time deliveries, and a lack of centralization. These issues had all largely been fixed before the pandemic, though the company didn't have enough time to show it through more consistent operating performance prior to the pandemic's distortions. For example, prior to 2017, Univar's sales staff incentive was a sales volume dollars driven, which led to sales staff being incentivized to cut price to drive volume. This upset chemical suppliers who felt their product was being cheapened by Univar, which led to chemical producers withholding future business from Univar, especially for specialty chemical products. This also led to sales staff concentrating on selling high volume, low margin product. which was a misallocation for distribution resources. Stephen Newlin, a prior CEO executive chairman, enacted a new sales force compensation structure in 2017 to combat these misaligned incentives, which led to a 1x increase in churn that year to 40% as salespeople used to the prior structure were managed out. Sales staff incentive was not based on gross profit dollars after logistics cost and not dollar sales volume, and sales staff could no longer control pricing. There was a shift from generalist sales staff to those focused on certain lines of business. UNIVAR was also plagued by late delivers prior to COVID, something the company was on the cusp of fixing right before the pandemic. From 2008 to 2014, Univar's US on time delivery rate stayed at a paltry 75% versus industry norms closer to 95% plus. Given on time delivery is the number one priority amongst surveyed customers, Univar's poor performance was a key structural headwind to sale, and was another factor leading to Univar's consistent price discounting to move product. On time delivery rates were low because of number one, inefficient long distance shipping, and number two, outdated IT systems. The long distance shipping issue was caused by the sales force not taking operating costs into consideration because they were incentivized purely on volume. Frankly, in many instances, the sales force didn't have an accurate read on their cost of delivery, anyways, given the company's antiquated technology. As a result, a product was being shipped uneconomically from faraway locations in order to satisfy local customer demand to meet local managers' sales goals, adding stress and complication to Univar's network, ultimately leading to late deliveries. Regarding the outdated IT systems, Univar's CRM was outdated, which caused a disappointing on-time delivery statistics. Sorry. Its CRM was from the early to mid 1990s was DOS based and required knowledge of very specific codes in order to get product shipped. Experts suggest only a handful of people within Univar actually knew how to use the system, leaving much more of the company to fly blind, leading to late shipments. This delivery issue was fixed also by the Salesforce changes. On time delivery returned to a normalized 95% level as the company re incentivized sales staff on delivered gross profit, i.e., gross profit after outbound freight and handling, which limited expensive shipments from faraway warehouses to meet volume quotas. In addition, the company invested in a new SAP ERP system as a part of the Nexeo acquisition, which led to improved on time deliveries. Management turnover had been a problem from 2009 to 2018, with the company having been managed by four CEOs during this period. Univar's relatively high CEO turnover rate has happened for a mix of unrelated reasons, e.g., wrong industry fit or CEO found a better opportunity, but has contributed to the company's inconsistent multi-year operating history. The appointment of David Jukes stopped this cycle, as he was universally well regarded and had been a successful operator for Univar historically. Lastly, macro headwinds in 15 and 16 and 19 compounded Univar's inconsistent operating history. Declining North America's energy market and industrial production in 15 and 16 led to a decline in profitability during this period of Univar. In 13, oil and gas represented 90% of Univar's sales, but given declines in US oil rigs started in 15, and this exposure had now declined to only 6%. US industrial production declined by -1%, -2% in 15 and 16. Both Univar and Brenntag experienced minus LSD to minus MSD percentage core EBITDA declines in developed markets in 2019 due to weak industrial production. Altogether, for the up and coming for the decade leading up to COVID, Univar had a challenging, undesirably operating history due to multiple factors. However, these problems had largely all been addressed, and the company was at an inflection point before COVID hit. Post COVID, e.g., in 2021, as the country struggled with supply chain issues, UNIVAR, like many distributors, benefited from a combination of inflation and the increased value associated with owning your own supply chain during a period of supply chain constraint. EBITDA grew to above normalized levels per the company's own admission, and the market rightfully feared that there would be some reversal in earnings power post COVID. Given the uncertainty between how much EBITDA was sustainable and how much was not, Univar's valuation recently has dropped to an 8x PE levels never seen during its public trading history except during the depths of COVID. My thesis on Univar is simple. It's a market leading distributor with competitive advantages, i.e., scale enabling more efficient distribution, first mover advantage, which benefits the company in its sticky customer relationships with specialty suppliers, which rarely churn suppliers, and a strong reputation in the industry and long term tailwinds to the chemical production and distribution from reshoring activities in the US. And its valuation is disrupted because of number one, historically challenging operating history for the decade prior to COVID that the company has not yet fully been able to prove that it's in the past. And number two, concerns that its earnings power is unsustainably high. In terms of the challenging operating history, I've outlined above all the fixes that were just beginning to show pre COVID. In terms of earnings sustainability, if you take EBITDA from 2019, i.e., the Nexeo synergies, its value capture, a cost savings program, and then factor in headwinds like OPEX inflation, you get to an EBITDA very similar to its 960 million of discussed sustainable EBITDA. Univar trades at 6.6x EV EBITDA on this sustainable number, a valuation not seen in its history except for the lows of COVID, by either itself or its closest peer, Brenntag, BNRGY. Catalyst, a core operating performance. Thank you very much for tuning in. See you next time.